Hello everyone and welcome to my video blog. My name is Nrupin and in this video I will try to explain what is book value in simple words. So for example, let's consider Jaiswal Juice Industries is business which manufactures different types of fruit juice. To make juice, Jaiswal Juice Industries have a big piece of land on which their factory building is standing. In that factory building they have all machinery, equipment and raw material required to manufacture juice. Along with that, they also have delivery trucks to deliver juice products to their distributors and supermarkets. Now let's assume the cost of land is 10 crore, the building cost is 10 crores, machinery and equipment cost is 5 crore and 10 crore is cost of raw material, delivery trucks cost 5 crore and finally Jaiswal Juice owns bank balance of 5 crores and stocks of other businesses worth 5 crore. Now if we add all of them, then we will get answer of 70 crore. In simple words, we can say that addition of Jaiswal Juice Industries cash and cash equivalents is 70 crores. Or Jaiswal Juice Industries holds net total assets of 70 crore. Now let's assume that Jaiswal Juice Industries have debt of 20 crore or we can say it have net liability of 20 crore. Having calculated net total assets and net total liability, we can calculate net equity or net worth of Jaiswal Juice Industries. Equity or net worth equals total assets minus total liabilities. In this case, total assets are 70, total liabilities are 20, so the final answer we get is 50 crore. Now what these 50 crore represent? It represents the amount that will be left in hands of business if Jaiswal Juice decides to sell all its sellable assets and pay all its debts today. Now let's assume Jaiswal Juice is listed on stock exchange with 2 crores of outstanding shares held by different shareholders. Now since stocks of Jaiswal Juice Industries are held by stockholders, the amount of 50 crore is supposed to get distributed among its shareholders. Here we have amount of 50 crore and number of outstanding shares is 2 crore. Now if we divide 50 crore by 2 crores, the answer we will get is 25 rupees. It is the amount that Jaiswal Juice Industries will pay its shareholders on each share. The amount of 25 rupees per share that its stockholders will get is known as book value. In simple words, book value is amount that shareholders will receive per share if business decides to sell all its assets and pay all its liabilities today. Now though it sounds good in theory that book value represents amount you will receive per share, but reality is book value can be very deceiving number for two reasons. First, business for sure can manipulate numbers to present good book value, but assuming this may lead to problems with security exchange boards, business are most likely will not manipulate book value. So the second reason due to which book value can be a deceiving number is important. And that reason is while calculating values for assets and liabilities, most current values are taken into consideration. Now problem with that approach is that value of asset and liabilities change on regular basis. Sometimes values taken into consideration are either very small or very big as compared to real value. Next, if business really decides to shut down today, most likely it will not get fair value for their assets. Next, a profitable business is most likely to sell at higher price and a business with losses is most likely to sell for lesser price. Price will always differ based on situation in hand. In spite of its deceptive nature, book value is important number to benchmark a business performance and to know about its overall health. Improving book value tells us business is in good financial health, whereas decreasing book value tells us about bad financial health. There are three things that can influence book value of business. First are assets, second liabilities, which mostly includes different types of debts, and third is earnings. Liabilities are financial obligations taken by business which finally needs to be paid back. Mostly they are nothing more than business debts or in simple words, loans. Increasing debts are bad for business and they result in reduction of book value. But keep in mind not all kinds of debts create equal negative impact on business, as that business can borrow money from banks, which are known as bank loans, or they can raise money by issuing bonds and debentures. Bank loans are considered as worst kind of business debts, and they are considered even worse when business is suffering from period of low earnings. Bank loans are considered as bad because business has to pay installments on schedule, which can make repayment a headache, especially during a period when business is struggling to generate more profits or has an expansion or growth planned ahead. By the way, if business have steady earning record, good execution of growth plans, growing reserves and safe appearing future prospects, then there is no need to panic. As safe investment option, you can look for stocks with low amount of bank debt. Bonds and debentures are considered as good debts because amount has to be paid later at some point in future on maturity. Next thing on list is asset. An asset is any resource from which business is expected to generate money either today or in future. Keep in mind, assets make money for business. Therefore, increase in asset leads to increase in book value. Mostly when it comes to acquiring assets, business usually tend to buy land as asset. The reason is land as asset tend to increase in value in future. Again, taking a debt against it is easy. It is not really uncommon for a business to acquire land asset just to take debts against it. This provides business three benefits. First, business gets money for its operation. Second, debts are secured and attract lower interest rate. And finally, when business ends up clearing its debt, it ends up sitting with an asset of huge value. Again, if business decides to buy a land asset for expansion and successfully pulls expansion, the cost of land sometimes double or triples just because a job opportunity has been created on that land. Finally, there are hidden assets. Hidden assets are assets whose value is unknowingly or intentionally shown less while calculation. For example, let's consider a business purchased some land asset. After purchase of asset, government declares it will build a railway station just 1 kilometer from that asset. This will lead to increase in value of asset within a day. Now, since value changed within a day, the true value of asset will get hidden behind its previous value. Unless business declares that the value of asset has been changed, no one will know it. After declaration of hidden asset, prices usually open with huge gap next day. Small businesses usually see massive surge in prices. Sometimes they might even end up opening twice or thrice the closing price of last day. The reason this happens because while investing, we literally are investing in business's ability to grow its assets and earnings with time. Which means either asset grows or earnings. Stock prices are likely to respond to their growth. Finally, earnings also have huge impact on book value. Keep in mind, earnings are nothing but assets in form of cash. Therefore, earnings also play an important role in value of book value. A business reporting net profit every year also grows in net worth. An increase in net worth means increase in book value. A business with increasing net worth, increasing book value and steady net profit can be a good candidate for growth investing. If you want to learn more about how net profits and increasing book value can help you invest in growth businesses, then check out our course Investing in Stocks for Big Gains. You can find link to the course in description of this video. By the way, before we end this video, let's take a look on what we saw in this video. First, book value is dependent on net worth. More the net worth, more the book value. Lesser the net worth, lesser will be the book value. Increasing assets and earnings will lead to increase in net worth as well as book value. Increasing liabilities or debts can lead to reduction of book value. A business whose net worth and book value are steadily growing is most likely either earning steadily or increasing its assets. With that said, I hope you found this video useful. So thanks for watching this video and have a nice day.